Welcome to this session. This is the part 2 of impulsive moves in forex trading. So please pay attention as I will explain to you how these moves happens in the market and where you should expect to initiate a trade. Alright? So if you can see from this chart, you can see that you will agree that market moves in waves. But it may not be exactly as I draw them on this chart, but this is exactly what market does. It moves in waves. That is how market moves. And these waves are called impulsive moves, either in an upward direction or in a downward direction. For instance, this is a bullish impulsive move, a correction or retracement. A bullish impulsive move, correction, bullish impulsive move, correction, bullish impulsive move. Since this support couldn't take out this resistance, it simply means that price has shifted in a downward direction. For instance, please, I'm not teaching strategy. This is just me showing you how the market moves how price moves in the forex market, so that you will begin to wait. You will learn how to wait for price to present the right opportunity for you to initiate a trade or execute a trade. All right. So this is what a bearish impulsive move, a bearish correction, bearish impulsive move, correction. See that? That's how it works. Bearish impulsive move, correction, bearish impulsive move, correction. So that's just how it works. You can look at the entire market. Let me take my chart to history or to the beginning of the 4 hours chart, so that you can see how these things play out. Because the problem is some persons don't know the exact places to take a trade, and that becomes a big challenge. You see that the market is showing you a red candle, you are taking a sell trade without knowing which of the move you are taking the trade from. Is it an impulsive move or a retracement? All right. So I want to take this back to history. Let me show you how it plays out. And just be patient with me. Okay, fine. This is the beginning of the 4 hours chart. All right. Now you can see. Just pay attention to this. Just watch. Bearish impulsive move, retracement, bearish impulsive move, retracement, bearish impulsive move. Let me show you. Bearish impulsive move, retracement, bearish impulsive. This is how the market moves. And again, we also have what I call internal impulsive moves and retracements. These are the ones that happens in a lower time frame. For instance, let me show you something. All right. In a lower time frame, like the 1 hour, that is where this will make sense. We have internal impulsive moves, retracement. All these ones are coming to agreement to take price to the external impulsive moves and retracement levels. You see this? They are all coming together to take price to where it's supposed to be. You see that? So you can find this everywhere in your chart, as long as you have been able to spot the trend of the market by identifying a break of a strong level of support. By the time you identify the break of a strong level of support, it simply means that price has shifted trend. So it means that you are now in a downtrend. So every support you are seeing is breaking for the continuation of price going in that same downtrend direction, for instance. And all these things are still playing out the same manner. Impulsive, retracement, impulsive, retracement, impulsive, retracement, impulsive, retracement. All these are what? Internal market structures, still doing the same thing. So the problem is that most traders don't understand these things. All right, you will see, for instance, a trader, you've spotted an impulsive move and you're taking a trade immediately on a sell without even waiting for price to do what? To finish her retracement level before continuation. You're taking your trade here only for you to realize that the market has gone against you, hit your stop loss, and you notice that the market still went to the direction you are. In fact, this is the problem with most traders. If you check very well, you're going to see that 70% of the times you are always correct with the direction of price, but your entries are the problem because you don't understand impulsive moves and retracement market structure. So from what you're seeing here, all right, this is, you can see printing clearly impulsive move, and we know that there must be what? At least a retracement up to 50% of the previous move. Impulsive move again, see that retracement up to 50% or 61.8 or 32.8 retracement level according to Fibonacci. Do you understand? And then you have the next impulsive move. There must also be what? A retracement of at least half of the previous impulsive move. Do you see that? We have an impulsive move, a retracement. See that? Half of what? The previous move. And we have another impulsive move, we have another retracement. This is what we call deep retracement, and then impulsive move. And since this low, since this resistance could not move to break the support, okay, it simply means that what price is about what to change trend, and we have another bullish impulsive move here. And by market open, we should have what? A retracement and what? A continuation. So this is just how the market works. I believe this video makes so much sense, and I believe that with this video, you now understand impulsive moves and retracement values or retracement levels. Okay, you can see this in a bullish. This is just a bullish trend on the 4-hour time frame. Okay, we have here impulsive move, retracement, impulsive move, retracement, and impulsive move. You see that all these retracement levels are at least, they went to at least 38. We have 38.2 Fibonacci level. We have 61.8 Fibonacci level, and we have 50% Fibonacci level. All right, this actually went to about 38.2 Fibonacci level. This went to about 61.8 Fibonacci level, and this one went about another 32.8 Fibonacci level. All right, this retracement here went about 50% Fibonacci level. Do you understand? So this is just how the market works. You will always have what we call an impulsive move followed with a retracement before you begin to think of how to execute the trade. We have a bullish impulsive, there must be a retracement. So don't always be in a hurry to execute a trade. The market is not running away from you. You have to allow the market to come to you. How does the market come to you? The market comes to you by meeting your trading parameters. Else, there shouldn't be any trading activities, or there should not be any execution of any trade. You should not enter any trade for any reason. And then you will definitely have what? After an impulsive move and a correction, you have a continuation, and then a correction or a retracement, and then impulsive move, correction, impulsive. This is how it is. So in a bullish trend, all you're looking at for is what? To execute a buy trade from what? The support levels, so that as price increases in value, you make profit. And in a downtrend, you always have what we call the bearish impulsive move. You have a retracement, you have an impulsive move, you have a retracement, and an impulsive move. Your mission or responsibility as a trader is to look for what? A selling opportunity on the newly created resistance in a downtrending market, so that as price drops in value, as price drops, not in value, as price drops, you make what? You make profit. Is that clear? So I believe this video makes so much sense, and it has opened your eye to understand better about how this concept works. See you on the next video. Bye.